This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Andrew Strasman. He happens to be a trend-following trader. I like to talk to trend-following traders. They're fun to talk to. You know why? Because I've written a few trend-following books. Andrew happens to have been around for a while. He happens to have some interesting experience, and he's a fun conversation. His firm, his commodity trading advisor, is Totem Asset Group. And look, if you're new or you're experienced and you can't learn something from Andrew, if you can't learn something from his perspective, how he got started, how he's achieved over the years, there is a problem with you. You should give up if you can't learn something from Andrew. Without any further delay from me, let's jump right into my guest today, Andrew Strasman, and get into trend following. I hope you enjoy. I've not started a podcast like this, but I thought to myself, given that we exchanged an email before we started talking, I noticed not a fear from you, but the concern that one has if you are a manager managing funds for clients, that people might not necessarily understand the regulation part. Generally, what I've done on this podcast is I usually keep things at the big philosophical headspace because I've been around long enough to know some of what a guy like you has to deal with, the issues that you have to deal with. Why don't you share with the audience, for example, when you come on a podcast like this, what are the concerns that you have from a regulatory standpoint about what you can't and cannot say?
There's two issues here. One is the watered down statement. Every time you say this could happen, you must also say this might also not happen. So the balance of risk statement, it makes you sound awfully wishy-washy. There's one issue that comes up with the regulators. The other one is I'm what's called 4.7 exempt. If my minimum is 2.5 million, I'm only dealing with qualified eligible participants. They're high net worth individuals. It's a further constraint upon what I can and can't say.
What would be the worry that I might ask from your perspective, a question, given that you're dealing with those types of clients? What would be the regulatory concern that you're concerned that I might ask about? Because obviously other people have probably asked you about it and you're sitting there going, oh man, don't make me deal with this.
The regulators are more concerned than I am.
What do they not want you to say, given that exemption you just described? I'm digging in the weeds here right at the beginning, but I'm curious.
Misleading statements. It's always past performance may not necessarily be indicative of future returns. I should think that should be obvious, but they make us say this every time we mention anything. It references to past performance, they shun upon.
But on the flip side, everyone's allowed to look at your track record if they're one of these particular candidates for your fund.
Correct.
Which is past performance.
Exactly. I love your story. You dug into the past performance of all these turtles and said, what makes these guys go? That story sells itself. What does it hold for the future? Who knows?
I think your experience in Chicago trading circles, the pits, goes back to the 70s. Is that correct?
Some of the people I work with started trading in the 70s. There's a couple of family offices and there are octogenarians and the good old times. But I moved to Chicago from Vancouver in 1991 because I saw the Vancouver Stock Exchange move to electronic trading. I figured I better get my butt to the center of the universe, which was Chicago at the time. I worked as assistant controller for one of Canada's largest introducing brokerage firms, sold everything and moved out to work in the pits.
Early 90s, first couple of years in the early 90s?
That would have been 1991. My first day was the Russian coup in the grain room. So that was exciting. I had already traded for myself at that time back in Vancouver, but I said, I got to figure this stuff out for real. And the only place I'm going to do that is going to Chicago.
You brought up the word turtle. And for those people that don't know, you're talking about the turtle traders, the students that were trained by famous commodities trader Richard Dennis, who's been profiled all around. Somebody's interested in investing in trading and they don't know about Richard Dennis. They're probably not really interested in investing in trading because they've not done their damn homework. There's the disclaimer. When did you first hear about that story?
I think it was with market wizards. The first day on the floor, the old timers will tell you, you got to read Reminiscences of a Stock Operator. I did. At first glance, it's an old timey story, this guy regaling you with his past history. But what they don't tell you, it tells you how to trade in that book. There's no other way of saying it. You only know this after you've traded and you can reflect upon it. I first heard about the turtles in probably 91 when Jax Schwager's book came out.
Before you got to Chicago, and you brought this up also about the performance track records, and it was something that got me inspired. Before you got to Chicago, you're trading by yourself, not necessarily connected to the trading world, so to speak, probably did not have a great Rolodex at that moment in time. When did you first start to piece together this whole idea of the trend following track records, something similar going on here? When was your aha moment on trend following? Maybe it unfolded completely different than mine, but how was your aha moment about piecing this together and going, okay, something is here?
The only way to do this is chronologically. Go back to the 70s, Pong came out. Pong, then Pac-Man. I was a kid really interested in video gaming. I used to get magazines on Pac-Man, and they had strategies and patterns. This is how to defeat Pac-Man, and they'd have a pattern. Sometimes you'd develop a path and it would work, and it would work. And then you would go to another machine. And that's when I found out there's a toggle in there. They can change the speed of the machine to make it more difficult, to eat more quarters and be more profitable, I'm sure. I'm like, okay, so this doesn't always work. That was my first introduction to pattern recognition and changes in the game.
Meaning the reliance on patterns. You knew early on, if I relied on this pattern, it might be good, but then, now I realize.
Here's your new reality. Your quarter's gone. It would have been 1983 at the Vancouver Computer Fair. They had a contest to see who could get high score on a video game that was yet to be released on a new gaming console, which was yet to be released. So they had a lineup of kids. Everyone got to play at one time. You got to choose 1 through 9, the level of difficulty. 1 was very slow, but you didn't earn very many points. And level 9 was really fast, but you earned a lot of points. And I heard one kid in line say, I hear there's a level 10 and you can get a lot of points, but you can't shoot. You're shooting asteroids and spaceships. It was asteroids mashup type game. Thought, that's interesting. You can't shoot. All you got to do is deke and evade. I go up with my 1 turn at this game. I played level 10. And true enough, you couldn't shoot, but all you had to do was evade lasers and asteroids and objects and that sort of thing. I rang up this massive score. I won the computer. I took that computer, which I didn't really want, and I sold it in $20 for a Commodore VIC-20, which was my first programmable computer. I learned BASIC on that. I was interested in gaming and all that sort of thing. Then I was interested in Vancouver and the stock market. Really quickly, you could see how classic technical analysis, things like stochastic, MACD, all these sorts of things I had an interest in early.
You could code them.
Yeah, it's like there's a formula. This is pretty cool. I started to get into the classic technical analysis and I thought, this is going to make me rich. What I learned from the Vancouver Stock Exchanges, it wasn't what you knew, it was who you knew. I don't want to get tangential with the story there, but I come to believe the big board is much of the same these days. They just have much bigger suits and whatnot. But I was interested in this trading business. I picked up a book, Wells Wilder, New Concepts in Technical Trading Systems. In it, he had maintained spreadsheets by hand. I'm like, I could put this into a computer. And I started to get into it that way.
So that Wells Wilder book, I had a friend back in the day, and he met a programmer. This programmer was the guy who put together all of those formulas, and he did it on that HP12C, whatever it is. He did all that stuff for Wilder, and then Wilder was the front face, but there was a guy behind the scenes that was doing all this coding on a little HP12C.
Oh, that's awesome. I just swallowed this whole. I was working as an assistant controller. This is fresh out of college. I got my first bonus. I did some exemplary work and I got a $3,000 Canadian bonus. I converted that into USD and had my first trading account. It was like $2,600. I was used to going to play blackjack and I'd start with $300 and play $5 blackjack. I usually end up with a little bit of money, never would lose it all. I thought I need to apply some of these things into what I'm doing, which is trading futures.
With $2,600 trading futures.
Correct. 2,600 USD in 1990.
Still not a lot of money in 1990.
Hell no. With my rules today, I couldn't trade. It's not possible. But I was used to risking $300. And I'm like, yeah, whatever. This is like going out to play blackjack for a night. I was taking a look. If you'll remember, it was the lead up to Gulf War I. Really wanted to get long gold in its flight to quality measure. It was $2,600 for margin requirements for one lot in gold. I'm like, that's not going to happen because that's my entire nut. I looked across the board. I'm like, you know what kind of will behave like that is, remember the old TED spread, T-bill minus euro dollar? I said that should behave similarly. It's only $25 a tick. So I got long a 2-lot of the TED spread, the original TED spread at 35 basis points. I was risking 6 ticks, which is $150 times 2 is $300. It was just like me going to the casino for a night. And I used a Wells Wilder volatility stop as a trailing stop. Got long at 35 basis points. Stop was at 29. I used the Wells Wilder volatility stop. Since I was assistant controller in Vancouver and it was a 9-to-5 job, that meant that my stop, I'd leave GTC. When I came in the morning, it was 11 o'clock in Chicago. Day is practically half over. Because I was busy doing other stuff throughout the day, I could just let the thing work and not look at stuff tick for tick. If that son of a bitch doesn't just keep ramping up and up week after week, I stopped caring about it at some point because it went from 35 to 50 to 80 to 110 to 120. And my stop is somewhere around 80 at that time, 80 basis points. And by the time we went into Gulf War actual, it was trading 192 right when we started dropping bombs. And my stop was at 178. It opened at 155. So this is my introduction to slippage. Oh, dude, they screwed you. I'm like, I just don't see it that way. I was long this thing from 35 to 155. That's a huge pull for this account size. And the only way I was able to do it was because I didn't care. I cared, but I was ambivalent. I was following the Wells Wilder volatility stop. I ended up just moving it once a week. I didn't know it at the time. That was my first trend following trade. My first real trade. That pretty much screwed me over forever because then I was hooked.
You've read Market Wizards. You got some first trading experience under your belt. You've got some mysterious line on your website, at least it seems mysterious to me, that you learned a trend trading from an iconic source. You can't say that on a website and then talk to someone like me. I'm going to pick on that. I'm going to ask questions. Now, you might be a very nice guy and tell me the whole story. You might tell me, no, Mike, I can't tell you the secret sauce, but there's something there.
No, Mike, I'm talking to an iconic source.
So tell me the story.
I got to go to Chicago. That's it. I go there. I'm making $5 an hour as a runner on the floor. They tell me to read reminiscences of a stock operator. I do. You're prohibited from trading as a clerk. It's a major no-no. I ceased all my trading activities because you were not allowed to be on the floor and trade unless you had a badge. I'm running around the floor, work in the grain room, work in the bond room, do night bonds. I do out trades. I do little programming projects on the side here and there, bootstrapping my way. Then I get headhunted to work for this French company. There's a couple of young guys running it, and they seem very gung-ho. They had a big office in Paris. And one of my goals in moving to Chicago was to learn trading, then go to Europe for a few years, and then eventually manage money, end up on the West Coast probably. I'm working for these French guys, probably 6 months, a year in. We have an overnight desk. We've got a guy working for us on our night desk, and he comes in at 5 and he's there till 7 in the morning or something. So we hit it off. He's a good guy. He asked me if I can help him program something. He goes, I can't tell you what it is or how I know. This is going to be very difficult. He says, I'd like to identify the highest high of the last X number of days. Boom, 2 seconds, easy. Then he asked me if I could calculate the average true range. Shoot, that's practically a built-in function these days, and even back then. Then I get this notion of buying a breakout, risking 1 ATR or 3 ATRs from initiation. I sit back and I look at that and I go, oh my God, that was my aha moment. I went, I've been thinking about this all wrong. Instead of trying to buy the low and sell the high, what I'm doing instead is think of you're playing Texas Hold'em, your big blind. If you've got a pair of aces, of course, you're going to go in and see the flop. But if you've got 2-8 offsuit, you might be able to limp in, but you're likely going to fold to any pressure. So call it what it is, an ante. It's an exploratory bet. That was my aha moment, is when I went, oh, you're just playing cards is all. That's it. There's no emotion to it. You're just taking a look. If it doesn't work, you're getting out. If it does work, it's like growing a garden. Give it a little bit of sunlight and water. Hopefully your garden grows. And if it doesn't, off with its head. No problem.
The concept of an exploratory bet, for the vast majority of people, you can say it very simply, an exploratory bet. But for the vast majority of people, it might take you weeks, months, years to bring them around to understanding so much complication that you've reduced to 3 words, an exploratory bet.
For me, that was it. If I have $100 and I lose 25 cents, do I care? I'm ambivalent. That's the key to, I think, good, successful trend following and trading in general. Is it's not that you don't care. You do care. You want to make money for your family. There's a lot of reasons why you like to make money. So you do care, but you need to be ambivalent about the outcome. If you're risking your entire month's rent on a trade, this is not going to end well. You might get lucky. In the case of my trade back in 1990, I got very lucky that I hit a home run with that first trade. But I grew to recognize that was a home run later. Not every trade ends like that. So you better have good risk management.
Usually people are risking the rent money recklessly every month or whatnot. Usually there's a lot of other things in their life going wrong too.
That's probably true. You can't trade scared. The only way to trade scared is to be properly capitalized. The way to do all of that and find success is to be disciplined and have stringent risk controls in place. This fella, this iconic source, he was best friends with one of the first generation turtles. The only thing I got that came from them, single page typewritten, more about the thought process in trend following and trading. I didn't ever get a look at the rules, but I had enough information. Really, I've got an active imagination. I said, X day breakout. That could be anywhere from 5 to 500. Investigate. Risking an ATR, that could be anywhere from 0.25 of an ATR to 8 ATRs. Investigate. I had just enough information. Actually, for me, this was better than being taught rules, because I think this would come out later in various sources. System 1 was a 20-day breakout. System 2 was a 55-day breakout. You had discretion to take or not take System 1. But if you didn't take System 1, you must take System 2, because you can't have a type 2 error. You can't miss out on those outliers when they happen. Already something between a 20-day breakout, something between a 55-day breakout, or something even longer. There's no right answer when it comes to trend following, but there's a way of looking at markets that just makes sense.
Your statement you said a second ago, oh, let's investigate. Does that go back to an earlier time before the Pong video game stuff, that mindset of essentially when you say something like that, if anyone says something like that, they're essentially saying scientific method. That's what you're saying. Where does that start for you?
I wanted to know. I want to tilt the odds in my favor. Does it really work? Could this work? Have I been looking at markets all wrong? Because in my opinion, I'm like, oh my God, I have been. The slow stochastic crossover, oh, gotta be a buy. Really? Does it have to be a buy? Maybe it could. And then you get reinforced with a bad idea because it worked. I had to dig into it.
The first thing you said was, I wanted to know. That was the same with me. I wanted to know because it was just fascinating that you grow up. I just finished an MBA early 94, waste of time, margin of safety, Buffett, thinking, man, I don't have this skill set. I wasn't trained to do this. I saw this brief thing about Jerry Parker. I stay far away from Wall Street. I use a trend tracking system. I don't know anything about the fundamentals. I'm like, what the hell is this? This is fascinating. The same thing would have been said in the Market Wizards too.
Here's the bottom line though. For me, it was working. The proof was in the pudding because I started trading like this. I got one of my first bonuses when I was at the French company. I put 10K into a trading account and I'm trading mid-am bonds, the half-size bonds, and mid-am yen, grains and whatnot. All of a sudden, I've got 18,000 and I've got 24,000. This was a golden time to be trading back in the mid-90s. There were big moves happening left and right. It was just really awesome time to be doing that. The regime at the time was conducive to it. Then I went to Europe. I worked in Paris for a year and I didn't do much trading at that time. I was too busy doing other stuff. Then came back to Chicago. I was working at Dean Witter. I started trading again. I was crewing for a fella, Don Wilson, DRW Trading, Dean Witter Futures. We were actually covering CTAs, and I was covering French banks.
What year would that have been?
That would have been 95.
Who was the CEO of Dean Witter Futures at the time?
I worked with Brian Walls and Leslie Richmond, with this group we had. I was speaking French to these French bank traders, shooting off 1,000-lot bond orders. It was a good time, but I was trading for myself then. And all of a sudden I got 40 grand in my account and 50 grand. I was crewing for this fella. He's one of our customers, Don Wilson, DRW Trading, is a behemoth now. He had a startup group that's covering one of his traders. I was crewing on his sailboat. He had a race boat down in Chicago Yacht Club. I was telling him about all his money I was making trend following. He says, shoot, why don't you come and do that for me? I'm like, why don't I indeed? This would have been 96 into 97. He grub staked me a $300,000 account size. I made $1 million my first year trading. We had to call at that time, call New York every morning, place orders. It wasn't as computerized as it is now at all. It was a fortuitous start for me.
Where is the typical life track there where you go to college, 18 to 22, you get out, maybe you go waste time in grad school or whatever. Where's the typical shit going on here? I don't hear the typical shit. I hear somebody who's doing this, doing that. It leads to this, it leads to that. There doesn't seem to be a plan, but you're on fire to keep chasing whatever keeps happening positive, this Bayesian chasing. Why? Why did you have that versus so many people? The vast majority of people I know are so freaking boring. I can't even talk to them anymore. Why do you have that? Seriously. On this podcast, I'm lucky enough to talk to very smart people that often go into academia. They go study something their whole life. But you and I both know that track of life is, okay, work for the man, follow the rules, sit in the office. And yes, they spend all their brain power to study some niche subject that we can all learn from. And that's really cool. But who the hell wants to live that life?
I'm taking it one step at a time. I'm definitely bootstrapping my way up, but I'm not going too far out over my skis this whole time. I'm having a lot of fun playing hockey. I'm going out late. I got the motorcycle. I'm having fun. So I'm getting a very good balance here. You say this a lot, working for the man. That's probably the bane, that whole mindset. For me, I've done some introspective thinking on this, and I was adopted. My parents got me when I was 3 or 4 weeks old, and that's my family. That is my family. I think, though, what's the worst that could happen to me? I shouldn't even be here. This is all found time for me. How are you going to hurt me? Your words cannot hurt me. I'm playing on the bank's dime here. Not like I've had a chip on my shoulder, but I don't get spooked easily that way.
We've got some great background and everything, but a phrase that you've used in your writing, and I've heard it before other places, I don't think it's come up on this podcast since inception, which is the phrase is, markets are maximally perverse. Now, again, that's one of those ones, I'm going to let you unpack it, but I think the vast majority of people that hear that, they're like, what the hell does that mean? They're probably going to think there's something wrong with you. Maybe that you're doing something on the weekends that's unusual or something. Tell my audience, what do you mean when you say the markets are maximally perverse?
That was one piece from my friend who was a friend of the first generation turtle. There was one phrase that stuck out to me. There's one thing on his little sheet that he's like, you can look at this, you can't photocopy it. Markets are maximally perverse. I always thought, what the Sam Hill does he mean by that? I think there's a few interpretations. The hard thing is usually the right thing. I'll give you an example. I take trades I don't, in quotes, like all the time. What kind of a moron is getting long crude at 140? This moron. There's trades that I don't like, that sometimes those are the best trades. Ones that just don't generally fit with the climate or the modern group think. And then I think another meaning for markets are actually perverse are the narrow exit windows when everything's very crowded. Everyone rushes for the gate at the same time, causing outsized fat tail events. I didn't coin it. It was originally a Rich Dennis thing. I know other people that were part of his works. When they hear that phrase, maximally perverse, it's a phrase that lets you know that we all know what the hell we're talking about. We've had the aha moment. We can switch gears to higher level conversations. How was your feelings on doing an add-on? It's a catchphrase, but I think there's a couple meanings behind it.
I spoke with Salem Abraham recently for another episode, and I affectionately named him at some stage of the game a second generation turtle. if I listen to you, turtle, friend, you, can we call you third generation in a way?
How about a tertiary turtle?
I think there's actually a significant number of people like that. And I think it goes beyond Rich Dennis, because once you dig past this, you're like, okay, here's Rich Dennis. But then who are Rich Dennis's peers? Oh, Bill Dunn, Ed Seykota, John Henry, Bill Dreiss. So there was all these guys out there, Larry Hite, all these guys that are peers of Dennis that all had their offspring's a terrible word in a sense, but it's true. David Drews was inspired by Ed Seykota. There's a lot of that stuff that goes on. It's fascinating. For me, I think the interesting thing is I started to meet people, and then I started to realize that the network amongst all these traders is not necessarily so strong. They don't necessarily all know each other so well. I started to realize that there was a lot of silos around the world, so to speak, where people were doing what you're doing. They weren't really communicating. That was another fascinating part, is that people were on their own islands doing their own evolution, coming to the same conclusions. Most of the biggest names out there, that's how it happened.
When I was at DRW, we had access to this machine. It was $20,000 a month to rent this machine and get all this data. Literally, you could plug in and ask it, what if I got long over the X day breakout risking Y ATRs? And you could plug this thing in there, say, and I want to apply it on a portfolio of, say, 40 different futures instruments. And I want to give it a range of 20 days to 500 days, this sort of thing. With compute power such as it was back in the mid 90s, we would just back of the envelope go, how many iterations is this? How long is this going to take? About 4 days to get the answer. Seems like a lot of time to be asking this question. So we had to use techniques to speed that process up. Kids have it so easy these days now because the compute power would be like, done. But back then we had to think about this. So we used a process called adaptive simulated annealing. And the closest thing I can liken it to is how a Japanese sword is heated, folded over, banged, heated, folded over, banged. Every time you do it, the sword gets stronger. Instead of brute forcing your way through 20, 21, 22 thought to 500, instead of going brute force back and forth, it would move the pointer around, say 22, 88, 300. It would force that pointer to move around randomly, and it would start to own in on areas of interest that seem to make sense. What you find is the reason these guys were all doing similar things is because they were working. Why did they do similar-ish type things? Because those were the things that worked.
Then you're right back to someone like me in the early 90s, looking through the Stark report going, what are all these names? Who are these people? But why are they all making money this month, losing money that month? And supposedly they're unaffiliated. That was just a fascinating concept. Some bigger than others, some smaller. You could see who were the Mac Daddies and who were the upstarts and all that kind of stuff. Ultimately, they had to take what the markets gave them. So, of course, if they're trend following traders, it's going to be similar.
There's many ways to trend follow, of course. Some guys do moving average crossover. I prefer breakout. Not to say it's easy. There's many different styles within the trend following universe. They're all looking to capture these large moves where markets move from one equilibrium to a new equilibrium. That's all you're really trying to get.
You brought up one of these technical analysis books, not the Wells Wilder stuff. Some of the Wells Wilder stuff is pretty trend following, but some of these other books out there. I remember I gave a presentation in New York once. It was the Market Technicians Association or something like that. 600 people in the audience. And I asked for a show of hands after I had described trend following. Show of hands who understood trend following as I was describing it. 10% of the room. So 90% of the people that were market technicians had no freaking clue what trend following was. Give an explanation to the best you can. The way that I've tried to do is say, okay, you've got these folks over here that want to use price or charts, want to say, if this happens, then this will happen. And then over here on the other side, the trend following traders are saying, if this happens, we don't know what's going to happen next, but we've got a plan for what might happen and we'll follow along. Two very different ways of thinking.
You just explained it. We don't predict. It's that simple. We have no freaking clue.
It's a personality that wants the cult. For me and you, if Jim Jones shows up and say, hey man, I got a little camp down in Guyana. We're just chilling out down here in the jungle. Got a big vat of Kool-Aid. And in case something goes wrong, we're going to drink it. I don't think the trend following traders say, yeah, Jim, we're going to come on down and hang with you. The other folks that are believing in all the mumbo jumbo, oh my God, Jim, you've got a camp down in Guyana. Let's go. I'm down there. I'm with it.
It's even worse, okay? Because When we had in the 90s gold rush, you had the guys on the TV, they were just pumping and dumping tech stocks. And it was so bad that CNBC had to use that disclaimer. Analyst does not have any exposure to the stock, nor does his family, nor does his dog, right? They had to come out with that little disclosure that the guy has no vested interest in the stuff they're shilling. And that's how bad it got. At least they had skin in the game, because now they come on and they prognosticate, but they don't even have any skin in the game. Well, why the hell am I listening to you? There's your answer right there. You shouldn't be. It's infuriating.
I have a theory that Kernan, Faber, and Kramer are not alive. They've been plastic or some kind of machine for a long time, and now they are fully digitized bots that will say anything. My theory goes further. If that's not true, let's say they happen to be alive. I can't prove it. But if they do happen to be alive, that when they do die, I will bet freaking money 100 years from now, those three dudes will be on CNBC.
The Walt Disney animatronics.
Well past that, I saw something the other day. A guy was just sitting on his porch and he was going to demonstrate a language AI. So he said a paragraph in English and then he pressed a button and it automatically translated his English to French. And his lips were now moving to the French translation, all on video. If they can do that, Kramer can be here 100 years from now, guaranteed. We both know that. Now, a lot of people will immediately hear this kind of conversation and they'll think, oh, the advances are coming. The AI is coming, and this will cause something to change with trend following. What people don't realize when they say that is, what is trend following? Trend following is just following along what the freaking crowd does. And as long as humans are humans, and as long as we keep expiring and a new round of humans comes along to learn the same lessons as the ones that just died, that maybe never learned the lessons, there's no way humans are ever going to change. There's no way trends are ever going to stop. And I guess if trends did stop and everything goes flatline, then we got much bigger problems not being able to trade trends.
The only decent move for me in the past year, it seems, because most trend is in a drawdown for, I'd say, about 10 to 14 months now. I also trade a basket of cryptos. I also trade a basket of individual equities. One of the only trades worth a hoot the past year to date has been that damn NVIDIA. I got long that back in mid-January, 108 or 114, I can't remember. But I rode that thing all the way up into 480 or whatever. I liquidated because I needed to. Now I'm not sure if it's going to make new highs or if it's going to take out the August lows. But if it takes out the August lows, I'll be right there to get short. If it takes out the highs, I'll be right there to get back in on this AI trend, if you will. But I don't know what's going to happen.
What's the difference between that move and some other move that you've seen in the last 30 years? They're all the same. It's just people pushing stuff up, people pushing stuff down.
Stuff gets thematic. What I'm seeing right now is, so you're long crude and then you're long ExxonMobil. Then look out if you get long defense stocks and you're like, that doesn't sound very good at all as they steam through the Taiwan Strait. There's someone out there knows something. That's a key feature to trend following.
You're not trading off the fact that there might be boats going through the Taiwan Strait. You should clarify that, right?
Hell no. Your positions are going to tell you the story. While I'm busy not trading, either I'm doing a sprint on a research project or otherwise keeping busy. Now, I do like to keep tabs on what's happening in the world, but sure enough, your positions are the only thing that matter, and price is the only thing that takes everything into account. When I got short stocks before COVID, I wasn't part of the Senate Intelligence Committee, but sure as shit, they told their buddies got out or profited from getting short. You don't have to know, but somebody out there does know. My whole point is, if you're living in Virginia and the neighbor's house is a 5-star admiral and you know he's deployed somewhere and the wife is baking a pie and it's sitting out on the windowsill, and then for no reason she yanks the kid and the dog, they jump in the car and peel out, maybe she knows something.
On the flip side, even if we know people that know something, how does that help our life necessarily? You might get lucky if you watch the neighbor peel out. More than likely, you're going to be like, no, maybe she's just, the guy cheated on her, he's running, whatever, who knows?
That's the rub in complex dynamic systems, is even having better information may not be helpful. If you know something too soon, then it's not really going to be helpful. You might take on a position that's going to eventually work out, but not before you get stopped out, for example. Or you might feel so strongly about it that you lever up and a small adverse move knocks you out. And then the incident happens that you know about. And then you're like, oh, woulda, coulda, shoulda. Not even having perfect knowledge helps.
You just said a second ago, you said price is the only thing that takes everything into account. You didn't say, Mike, now listen to me. This is a very important thing I'm about to say. Price is the only thing that takes everything into account. You just rattled off 5 sentences, and in the middle of those 5 sentences was price is the only thing that takes everything into account. I still think, even after people have read some of these books that I've written, they've listened to some of these great traders and stuff, they know that sentence. They still don't know what the F it means. They have no clue. Even people that read the books that listen to this podcast, they listen to you say it, and they have no effing clue what it means at all. And then right back to, what do you think is going to happen tomorrow? It's true.
You can't tell till you bet, and you've got to go through some observations. That's the only way you're going to truly have an aha moment when it comes to trend following trading. You and I both share this need. You want to spread the gospel, help educate people.
I don't know if I want to anymore. I just like talking to smart people, and it keeps my brain active, and maybe I'll live longer or something. The world is so nutso, and there's so much ego out there, and there's so much emotion. Someone listening to this episode, they might say, well, that guy Mike, he sounds a little agitated or a little elevated at some various points in time, but I'm not.
You're passionate.
Yeah, I'm not unusual in the sense that you got to be pragmatic about life. I find the folks, even like you, I caught the one line that you said, it wasn't raining when Noah started to build his ark. That's a very simple statement. Everyone gets it. But if you go ahead and you add to it and you say to somebody, and I've done this recently, do you remember how they jacked up rates during the dot-com bubble? I said, do you remember how they jacked up rates during the Great Recession? You know, they're jacking up rates right now. Now, that doesn't mean that the rates that are being jacked now will have the same effect as last time. But do you also recall that Noah started building an ark before the rain came? It's like cognitive dissonance. They're like, what the hell are you talking about? That's not going to happen. We're in a brave new territory right now. Everything can only go up. You just shake your head and you're like, okay, man, back to Guyana. Jim Jones, Kool-Aid, please. Okay, let's go.
It's because they all related to the S&P 500. That's all they think about. You go, do you know why it only goes up? They go, no, I don't care. I'm like, well, you probably should investigate it. Every 2 weeks, hundreds of millions of dollars of 401k money comes in. It just gets allocated to it. It goes into 7 companies by and large. And those 7 companies are the only reason the stocks are up on the first place on the year. You get massive consolidation. They get rid of the bad stocks. They add the good stocks.
For some reason or another, most people don't care if they lose because they feel like if they're losing, everyone else is losing. And some reason or another that pacifies them or makes them feel okay, that instead of making another decision, they go along with the crowd. And if everybody in the crowd is losing, then they're not really unhappy, which is entirely bizarre. It's the same way mutual funds all work, meaning these guys that run the mutual funds don't give a you know what if they lose money because all their friends that are running the mutual funds are losing money too. There's no incentive. It's a crazy game.
I'm with you. It drives me crazy. In '08, you hear a guy goes, I crushed it last year. And you're like, oh yeah, we had a good year too. What'd you do? I was down 20%. And you're like, that's crushing it? The overall market was down 26. Booyah, take that. You're insane. That makes no sense. Crushing it.
You and I will never convert them. We'll never do whatever. We exist in some alternative universe, alternative parallel space. And occasionally somebody breaks over and they come over to our side and they want to participate. And then maybe we get a new friend or something. But otherwise, it's some kind of Twilight Zone episode where the invaders come to Maple Street or something. And the aliens are sitting up there on the hill, watching everybody down there run around. That kind of thing is really what's going on.
The bottom line is trend following done correctly is about as exciting as accounting. Doing it every day in, day out. If I'm monitoring 34 instruments and I'm checking every 10 seconds if I need to make a trade, which I'm doing around the clock, most times the answer is no. And then there'll be those other times, those very few times where the answer is yes, there's some wood to chop. That's why I have the computers do it for me, because they're going to do a much better job than I am. And it frees me up to not be looking at stuff tick for tick. If you want to do things correctly, people will find it takes a lot of discipline. Now, I happen to think they could put in GTC orders every Sunday night and go be the best damn dentist they can be, or a surgeon, or lumberjack or n'importe quoi, whatever their station is. I think they could do that, but can they do that every week, all year? Can they handle the lows? Can they not get too ebullient during the highs? Those are unanswered questions.
If they can't, there's always AI Kramer and AI Kiernan and AI Faber on TV ready to give you whatever you want to hear.
And then the wealth advisors, the reason you make 8% per annum compounded annual growth rate in the S&P 500 is because every now and again, it falls 50%. Reward is always commensurate with risk.
The 50% was a long time ago. I forgot about that. I don't need to think about that. Historical stuff is all out. Andrew, we definitely got to catch up every now and again here. I enjoy talking to you. Where can we send people? Where can people come check you out? Money management side of things, the educational side of things. You've got things to say. Where can people come find you?
For qualified eligible participants, i.e. high net worth people, can come to the website at totemasset.com. Everyone else who's interested in learning about trend following principles, they can follow our academic project where we publish CTA trend beta every minute of every trading day at www.40, the number 40 in, the number 20 out.com, 40in20out.com. We just run a very simple trend following strategy for people to observe how it behaves. A better educated investor makes for a better investor. Like you, I want people to understand how trend following works and see how that fits into their investment profile, if at all.
Andrew, cool stuff. A shout out to Peter Borish for connecting us. Peter, a good guy. I didn't meet Peter probably in 94, 95 because he was one of the first people that just saw my energy and just opened up a door a little bit and said, why don't you walk through this door, guy? And I did.
That's great. Yeah, I'm going to see Pete next month.
Cool stuff. Andrew, let's stay in touch. I appreciate the conversation today.
Thanks a lot for your time.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.